And as we continue to look ahead to what's on tap this week with the Fed minutes and CPI data, let's bring in the co-founder of the Economic Cycle Research Institute, Lakshman Achuthan, to break it down. Lakshman, always a pleasure to speak with you and get some of your insights. Help us tee up this week. I mean, we've got a ton of data. Of course, last week was the big kind of employment reading across the board, from private payrolls all the way into some of the JOLTS data that we had seen, even though that's lagging a little bit more. And of course, the monthly jobs report. What does that set up for what the Fed is also going to be tracking on pricing more broadly this week and what consumers are actually paying?
Great question, and thank you for having me. Good morning. Jobs data, CPI data this week, jobs data last Friday, CPI data this week. Those are all what we would call, from a cyclical kind of monitoring point of view, coincident data. And the Fed has declared for many years, it's kind of what got us into this pickle in the first place, that they're going to be tracking coincident data in order to figure out what to do. And every once in a while, you'll hear that they're data dependent, and that's a little bit of an eye into that view. And so we look at the jobs data. It was a pretty good report on the face of it. Year over year, jobs growth actually is trending down. It's about a year and a half low in the growth rate. So cyclically, we know which direction we're going in. But the jobless rate at a half-century low, 3.5%, on the face of it, that's hawkish, more hawkish Fed. It's not what they want to see at this point. They need more weakness in the labor market, and they've said that in various ways. And then when you look to the CPI, coincident inflation data this week, probably too sticky, probably too hot. Our cyclical view, right, forward-looking cyclical view, is that actually the peak is in, right? And a cyclical peak has already happened in inflation. We are trending down. The problem is that it's going to be very sticky. You might get some relief in the pace of goods-related inflation, but the services side, where most of the spending happens, including rents, for example, very, very sticky. And as a result, in the earlier segment, the point was made that, core is going to be sticky. They're looking at core coincident inflation. So again, kind of a hawkish angle to the Fed, trying to make up for the earlier mistake of missing the inflation cycle upturn, continuing to slow the economy.
So, Lakshman, you talked about where we are in the inflation cycle. What about where we are in the overall economic cycle, right? Because what we've been hearing from guests as of late is the tenor has started to shift a little bit from being pretty darn confident that it was going to be a mild recession if we get one, to maybe leaning a little bit more into, well, maybe it's going to be a little bit more severe than we thought.
Thanks. Excellent question. And this is how we edge into the realization that, yes, there's a recession. And markets and analysts can be kind of manic depressive, right? So they'll be like, no, it's not happening. And then all of a sudden, as it becomes more obvious that something's afoot, they can overdo it and get more extreme the other side. Our analysis is that, yes, there is going to be a recession. To be clear, we will need to see job losses for there to be a recession. Also, to be clear, there have been several instances historically where recessions begin before job losses begin. One of the more extreme examples would be the 73-75 recession, which was a very severe recession, which began, and then jobs actually kept growing for 8 months until you actually saw jobs start negative. So the recession itself began a little bit earlier. This is getting into the weeds about how recessions are determined. And we may be seeing some of that here because it was so hard to find the people that you needed to work that businesses are very reluctant to let them go, even when they're starting to see the difficulty on earnings. And you were saying in the earlier segment also I was watching about how this earnings kind of recession feeling is coming in. And FedEx, for example, it's just like, forget it. We can't even say anything. It's a global recession, and we don't know what's going to happen. And global recessions, to be fair, they are more severe than your kind of garden variety recession. So I think that's a reasonable thing to be thinking about in your scenario planning.
Do you think the economy next year will start shedding jobs like you mentioned?
Yes. Look, if we're right and there's a recession, and I think that we are correct here, then by definition, there must be job losses. The question will be how much. Structurally, there's a lot of issues and tightness in the labor market, so that may limit it to some degree. We have seen, as I mentioned, in that inflationary kind of 70s period, where the nominal numbers look pretty good, that businesses were slow to let people go. I mean, it's very, very expensive to hire someone and then let them go. You have to train them up and then you have to let them go. That's the last thing you want to do as a business manager. So I understand why that is, and they're hopeful. Certainly, you see all the time. There's a lot of hopium. You use that. I was watching everything this morning. You were using the hopium word this morning, and there's a lot of this. This comes up in the market talk. Oh, maybe they're going to pivot. Maybe they're going to bail us out. I don't think that's going to happen, but that kind of talk probably is keeping some of the jobs growth going too.
Lakshman, how does the Fed then react to all of this, right? There is the talk of pivot has faded away a little bit. But at some point, do we see the Fed sort of quickly trying to backpedal here and fix some of the economic damage that it looks like that the policy could cause?
Yeah, I mean, I think that we wrote at the beginning of the year in January, we wrote that they had a choice of two mistakes, right? And meaning that they either had to take a recession or they had to let inflation run out of control. I'm just being overly simplistic. And they've chosen the recession. So the intention is the pain. That is the goal. And I think Powell said as much in one of the Q&A things a week or two ago. And so will they go too far? I mean, in the sense that there'll be a recession, I think yes. And they, I think, believe that they have the tools to countermand that at some point and ease up on the tightening. But by their own definition, they're saying that they want to see the pace of core CPI growth, depending on various measures of looking at it, drop down. And by all the analysis and the nowcasting that we're hearing, this week's CPI is still going to be sticky. And we think we understand why. It's probably more in the services side that it'll be sticky. But the Fed is saying if it's sticky, we're going to stay the course. And that's not what the market wants to hear. So we probably have this slower grinding. And again, you had mentioned earlier, it's tempting because prices are down to start to look for bargains, longer term bargains, but you're going to have to accept a lot of volatility because this chapter isn't over yet.
Okay, so with that in mind, and also given that you've studied previous economic cycles, we know that the markets try to price in the risk of a recession well ahead of time. But sure, what would that bottom out period look like in relative to now, relative to the declines that we've already seen over the course of 2022? And when might we see that bottom?
Hard to say magnitude-wise, right? So if it's a global recession, and the odds are high, I think, of that, it could be more severe. So the recognition of that may mean some more downside volatility. The question then is, where else do you put your money? and it's hard to figure that out. So there's a lot of maybe this isn't the worst place, even though it's going down. These bigger recessions, you could see larger retrenchments in equity prices than we've seen so far. So that's totally in the cards. The relationship between equities and business cycle recessions, is that they do tend to sniff out the recovery before the bottom of the recession by a few months. And I have no reason to believe this cycle wouldn't be different. Looking at other leading indicators, of non-equity related leading indicators, it doesn't look like the bottom is in sight yet. And so that's why we were very suspicious of the soft landing bottoming narrative that developed a few months ago. I think that the S&P was like in 3,600, right around there, 3,660. And it was like, that's it. We're seeing the light at the end of the tunnel. We could see across the valley. And of course, that was premature. I think we have another leg down here, it sounds like.
That is indeed what we call a head fake. Lakshman, Achuthan, Economic Cycle Research Institute co-founder. Always good to see you. Have a good rest of the week.
Nice to see you too. Thank you.